There's new inflation data showing that prices are remaining stubbornly high. Producer prices coming in above estimates across the board. The core number, which excludes food and energy, rising 0.5% month over month. That is compared to the 0.2% rise that was expected. The revisions in the prior month lessening that impact of the surprise here. So what could this mean for the Fed and for markets? Joining us now on this, we have John Porter, Newton Investment Management Chief Investment Officer and Head of Equity. John, thanks so much for being here. We're expecting to hear from Fed Chair Powell any second this morning. I'm curious, from your perspective, what does he need to address from this PPI print, if anything?
Well, from this print in particular, I don't think he really needs to address anything. But what the markets clearly want to hear from him is that he's committed to a path where the next move in rates is down. And I don't think that we're going to hear him wavering from that narrative at all. I think that that's the primary area of focus right now is, a focus on when the next cut is, not if. If the market starts to debate the possibility of rate hikes, that becomes a much bigger challenge for the market to digest, in my opinion.
Is that something that you think is on the table, John?
I don't think it's on the table at this point. I think the Fed knows that underneath the covers of an economy that looks pretty strong on the surface, there are some unmistakable challenges from the current level of interest rates. We've certainly seen it in the turnover of existing homes, for example. You're seeing it in some of the small business formation numbers. You're seeing it in small business confidence. So I think underneath the surface, they know that the higher rates are really pinching some corners of the economy, but the aggregate economy is solid right now.
Well, I want to switch gears a little bit to talk about the earnings cycle. Our colleague Josh Schaefer has a story out on how earnings growth for the S&P would be over 8% versus the 5% move if it wasn't for Bristol-Myers earnings. How do you ride the momentum of this market as we're wrapping up the earnings season and as we know that one stock can put that much of a damper on any momentum from the earnings rally?
That's absolutely true. There's a handful of stocks that, because of the magnitude of their earnings, they can distort the total picture. But I think if you step back and look at this earnings season, it was a very strong earnings season across the board. On average, in the S&P 500, the average company beat earnings estimates by somewhere in the neighborhood of 8 to 9%, which is about double the normal beat rate. So this has been a strong earnings season. And importantly, it's while there have been a handful of very large companies that have had a big impact on that, the breadth of the earnings improvement is continued to improve, and I think that's leading to a bit of a broadening out of the market.
So then as the earnings season does start to wane here, I know that you've said that that's responsible for a lot of the momentum. What will be the next catalyst for the market as earnings does wrap up?
I think we're back to focusing on the macro. As you mentioned earlier, Madison, today, the detailed analysis of PPI, we're going to get CPI tomorrow. There's going to be continued focus on the macro. It's really remarkable to me that we're sitting here in mid-May with a broad market up 8 or 9% so far, and we've gone from an expectation of 6 rate cuts at the beginning of the year to now just 1 or 2. The resiliency of the market in the face of much more modest rate cut expectations is very impressive to me. I think the focus is going to continue to be on all the inflation headlines to assure us that the next move is down. When it's going to happen is a very difficult question to answer, but as long as the market continues to feel the next move is down, I think you've got a good support for the broad market here.
John, when you take a look at some of the moves that we are seeing, you got to take a look at least the meme rally and what we are seeing in GameStop, what we are seeing in AMC. I'm not going to ask you to specifically comment about that rally that we're seeing in those specific names, but I'm curious from a macro perspective, should we be paying attention to this at all, and why not?
Sean, I wish I had a better answer for you. I don't know. You absolutely should be paying attention to it. The question is, what's the message? Why is this happening? What's underlying this move in markets? If you step back, when we had a meme stock rally, back in 2020, 2021, when it was all the rage, when you really got behind it, there was an undercurrent of liquidity there that was an important catalyst for what was going on. If you really understood the implications of liquidity, both in terms of juice for the market, but also to the opportunity for it to create inflation challenges, it would have been some really important issues to understand underneath the surface of that meme stock rally. Is there something like that happening today? It's too early to tell. We're 24 hours into this meme stock rally. But as a fundamental long-term oriented investor, I'm certainly cognizant of any short-term volatility and trying to understand if there's a turning point in the market that I need to have a better grip on.
Yeah, and John, that's what I was curious about, just this exuberance that maybe this signals that is in the market clearly, what ultimately this could essentially mean. Even with Powell, he has commented on the meme rally in the past, going back a couple of years, but even how the Fed could potentially be looking at some of this excitement and then what that ultimately means here for the broader markets and for strategists like you.
Yeah, I would hope the Fed, like myself, is paying attention to everything, but you also need to have it in keep things in context. I mean, the U.S. economy is what, 22 trillion or something of that magnitude. So you mentioned off the top the losses that shorts had in GameStop and so forth over the last 24 hours. Those are a small drop in the bucket in this massive ocean of our economy. But again, the Fed's not doing their job if they're not paying attention to every marginal incremental data point, trying to understand it. When you look across other parts of the economy, there's plenty of evidence that there's some challenges underneath the surface in the economy that the Fed needs to be mindful of and be cognizant of when they think about their rate policy. When you look at some of the consumer data points in Q1 earnings, you saw some evidence that the pinch from inflation is starting to be felt by consumers. You're seeing on the margin some slowdown in certain cohorts of consumer behavior. And I suspect the Fed's much more worried about that than they are one or two stocks adding a few billion in market cap.
All right, John Porter, always great to get your insight here. Thanks so much for hopping on and joining us here this morning. Newton Investment Management Chief Investment Officer and Head of Equity.